Hello, everyone. This is Sebastian McMahon from IA Financial Group, and I'm back with another weekly economic review, this time for the week ending May 27, 2022. So let's start with a look at this week's markets at the close on Thursday. So another positive week for bonds. So it's been a few weeks in a row now that we've had positive returns. So rates going lower. We've been adding exposure to bonds over the last few weeks. At least a few weeks ago, we did a few chunks. We're lucky with the timing here, so adding some value. We're still in a negative year to date, but getting at least on the right side of things in the short term. Equities, we just closed 7 weeks of negative returns, 7 consecutive weeks of negative returns on the S&P 500. That was one of the longest streak in decades. And unless we have a catastrophe today on Friday, and it's not looking like that as the market is in the green in the morning, well, we should break the streak, so that's a good news. And even in the short run, we are starting to think that there might be what we call a bear market rally unfolding here. So you have oversold conditions, and I'll show you in all of the details in a few minutes how even when you have long-term bear markets, and we do think that there's lots more downsides coming, well, in the short term, you can have those bear market rallies. So when the market goes up, you can have corrections, even if the market goes up for multiple years. And if the market goes down, you can have bear market rallies. And history says that it's the norm, it's not the exception. And we might be starting one of these. So we did do some repositioning in our portfolios. We were underweight equities. Now we we brought it back to neutral equities today just to be positioned. So the idea is not to go overweight equities and, take undue risks in the portfolio, because we never know when things might change, and our long-term charts are still pointing towards more pain ahead. But we want to, of course, expose our clients to the opportunities that are out there. And oversold condition in equities, that's a good opportunity maybe to play in the short term. So we'll keep you posted on how this evolves through time. And it's not an exact science timing the market, of course. So TSX is still outperforming year to date by about 11%, so this trend continues. Oil up on the week, USD CAD up, Euro up, and the price of gold also higher. So if we look at economic data, well, I like to look at surprise indices because it summarizes the state of things. So it's an index published by Citi, the US bank. So what they do is they look at the forecasts or the consensus of economists that is surveyed by Bloomberg, and they look at the data that comes out on a daily basis, and it just aggregate that. So when you have an upside surprise or a beat versus expectations, that pushes the index higher, and when you have a negative surprise or a miss, that pushes the index lower. And here we looked at the monthly changes, so every month in the calendar since 2004. And as you can see, if the month of May ended today, that's why it's a light shade of gray on the line, well, that would be one of the worst month of contraction of surprises. So the biggest the largest amount of negative surprises in 1 month since COVID, and before that 2008. So that was pretty bad, pretty dire for economic data in May. So that was one of the worst crashes in economic data in history, and that's of course, markets are always expecting things. They're always trading ahead of things. So the pull down in the markets since the beginning of the year, there was a part of the anticipation that this would happen. So it's there, and that's what we see here in the chart. If you look at the PE, so the price earning ratios or the valuation of the market, well, you've had already a strong contraction in the price earnings ratio. So the amount that people are willing to pay for every dollar of earnings that's coming over the next 12 months in the S&P 500, that's the PE ratio. Well, the change in 90 days, now it's pretty much in line with 2020 and 2008. So that was quite a contraction in PEs. Again, expecting dire economic news. Probably most of the downward movement is already in. I think there's still more downside for valuation, of course, but maybe the largest part might be in. So let's see. But the next shoe to drop, as you can see here, is the earnings picture. So The chart on the left, I'll go slowly. So you have two lines on the top of the chart. The blue line is the earnings per share on the S&P 500 for the last 12 months. So this is realized, but the gray line is the expectations for the next 12 months. As you can see, it's going higher and higher, and it actually analysts, because those are analysts forecasts that are published on Bloomberg, they expect 18% growth in earnings from businesses, and we think that's way too high based on our views on the economy, which I share almost every single week. So you know that we're pretty downbeat on the economy here. So a few things from this chart is that, well, the gray shaded areas on the left hand side chart, that's recessions. So as you can see, analysts tend to be very optimistic until a recession hits, and then they revise downward the expected earnings. So they're lagging, they're not looking forward, and we're starting to see the downgrades happen slowly but surely. Chart on the right, the earnings upgrades versus downgrades. Now we're seeing lots of downgrades, and it's starting to push the index into negative territory. So we think that's the next shoe to drop. So probably half or 2/3 of the market drawdown is in, somewhere around that. The first part was valuation coming down, but the next shoe to drop will be actually earnings starting to come down, and that could bring the market down sizably. So this is what we're expecting, and this all seems maybe very theoretical. So let's go to some real names, some real economic indicators. So you have here John Deere, so a good bellwether of the U.S. economy. So the stock plunged the most since 2008 recently based on supply chain issues, inflation issues. So they're worried that they won't be able to meet their targets for profitability, so for earnings. So that's one. Walmart, Target, mentioned that over the last few weeks. Both are worried about higher costs that's going to eat into their margins, their profitability. So earnings should be revised lower here. Lower than expected sales of discretionary merchandise. So that's going to hurt the profitability of these maybe higher margin items. So a few real examples here. And if you prefer the new economy or the darlings of 2020, 2021, well, you have Snapchat, Uber, Facebook, you have Coinbase, Wayfair, Robinhood, Canopy Growth, Peloton. They're talking about downsizing, cutting costs because they're worried about their earnings targets, cutting jobs. So it's all going to happen throughout the year. So this is going to be probably a slow boil. Earnings are going to be having to come down, and that's not going to be positive for the market. But if you look at this picture here, in long-term bear markets, because we think that we're going to be entering a bear market at some point. We're still in that camp. We'll tell you if we change our minds, but you do tend to have short-term rallies. So bear market rallies, they can be 5%, 10%, 15, 20%. We've seen that in the past. So you have two examples here. You have 2000 to 2002. You have 2008, 2009 on the right. So once there was a 6 bear market rallies, the other there was 5. So this is the norm historically. History tells us that even in long-term bear markets, you should expect those bear market rallies. And now we're seeing oversold conditions. We're seeing maybe the peak in inflation soon. We're hearing the Fed talking about maybe there could be a pause during the summer. So that could be enough for bear market rally before at some point, well, the oversold conditions are not there anymore, and we start focusing again on earnings. The picture is not too good, and we could be into another down phase. So this is what the roadmap that we have. And again, if it was the flip side, even if you think that you're set for a long-term bull market, well, you should expect corrections along the way. So it's natural also to expect short-term rallies in bear markets. So again, what we did today on Friday, we added some equity exposure in our funds to remove the underweight. So now we're neutral. We think it's good to be neutral. Going overweight equities, not quite there yet. I mean, we're not gambling with the client's money here. We don't have a strong conviction that this is a durable rally, but at least want to be positioned less defensively for a short while. And let's see how long it lasts. We'll be keeping you updated every single week on how our views evolve on that matter. So what to watch next week in Canada? We'll have GDP growth. We'll have Bank of Canada rate decision on Wednesday, 10 a.m. Eastern time. Should be 50 basis points hike again. So that would bring us closer and closer to neutral. So maybe there's a few of these, couple of these 50 rate basis points hike to go yet, and it's still, and then probably we could have a pause. So let's see what they tell us following the decision. Also, we'll have in the US the ISM manufacturing and services in PMIs, and we'll have the jobs report in the US only next week on Friday. In Canada, it's going to be the other week, but consensus that's going to be a bit lower at 332,000 jobs. So that wraps it up for the week. ia.ca/economy. Go to webpage. You can subscribe to the newsletter if you haven't done so already. Economy and Finance 101. There's some new material there. I encourage you to give it a look. You can follow me on Twitter, on LinkedIn, and if you want to copy a PDF copy of this presentation when the video is up, it's already going to be there on LinkedIn. So just search for my name and you'll find it very easily. So thanks everyone for following every single week, and I'll be back again next week with another edition of this weekly economic review.